Insights into Real Estate Investment and Passive Cash Flow with Lane Kawaoka, episode 167. Are you ready to make your law firm a profit-generating machine that will free up your time and skyrocket your impact? With more than 2 decades of business growth experience and having proven that you can be successful while prioritizing your family and your impact, introducing the Profit with Law podcast. I am your host, the creator of the Firm Differentiator 10X Effect, Moshe Amsel. Well, hello and welcome to another great guest interview here on the Profit with Law podcast. I'm your host, Moshe Amsel. Let me share an exciting tool that I recently came across that is a game changer for law firms that bill hourly or by the project, otherwise known as flat fee billing. The 2020 Legal Trends Report published by Clio rates how important various items are in a client choosing your firm. You may be surprised to know that the third most important decision factor for someone choosing a lawyer is the ability to pay with a payment plan. The challenge that law firm owners face is the risk of a client not making good on that payment plan. Most attorneys don't offer payment plans because of that. The problem is now solved with LawFunder. LawFunder allows you to easily add a payment option to all your client invoices and retainer replenishment requests that does not require credit checks, applications, or any other complex process. The client's able to use their existing credit cards, allowing them to earn points and miles, access credit card specials on interest rates, and any other tools they use to manage their cash. When I saw this tool, I was blown away. Most importantly, it removes all the risk from the law firm and makes an easy and painless process to the payment process. So if you want to check off the box on one of the top factors in new client decisions, if you want to decrease your accounts receivable and get paid immediately, LawFunder is the solution. Go to lawfunder.com. That's lawfundar.com/profitwithlaw to learn more. 2025 came 5 years early for the legal industry. The way we find new clients, the way we serve our clients, and the way we operate has fundamentally shifted. Everyone now knows how to do a virtual client meeting. Some of you are even doing virtual hearings with judges. Google has become the new referral source, and it seems like he or she who has the most 5-star reviews wins. Staff has demonstrated the ability to work remotely and be productive this way, leaving you, the firm owner, to wonder whether an office is needed and how else can you take advantage of a global workforce. Lawyers love attending conferences because lawyers love connection. 2020 and the COVID pandemic has been the most isolating experience we will likely ever experience in our lifetime, and more than anything else, we are craving human connection. Hi. I'm Moshe Amsel, host of the Profit with Law podcast and founder of the Law Firm Growth Summit. Last year, pre-pandemic, we hosted the first massively successful virtual summit for law firm owners. We had over 30 speakers and well over 2,300 attendees join us for this monumental and industry-changing experience. I am here to tell you that the Law Firm Growth Summit is back, and we have put a new meaning into the term version 2.0. Let me begin by describing the experience you can expect at the Law Firm Growth Summit. We have created a physical stage and a conference platform with every intention of making this virtual experience as real as possible for you. The equipment was trucked in on 2 tractor trailers carrying a 32-foot stage and a video wall consisting of 108 video tiles and 216 LED modules, allowing us to bring you an experience in over 3 million pixels of true color. Not only do we have a main stage for presentations, but we also have a networking area where you can connect with peers, breakout rooms where we will host hands-on workshops, and you can meet some of your favorite speakers and podcast hosts, and a vendor area where you can meet and connect with various technology and service providers that are sure to help you continue your firm on the road to profitability. We cannot virtualize hugs, but we can bring a remarkably engaging experience right to you. Over 40 speakers will be hosting a series of keynotes, main stage talks, and breakout room workshops to take you on the journey you need right now, today, to become the most relevant and profitable firm in your area. We will help you navigate the complex issues of the business of law in the new post-COVID world. Sessions on marketing and lead generation, staffing and leading a virtualized team, pricing your services to be relevant to the next generation of clients, and financials. Learn to collect your fee quickly and become super profitable. Some of our world-renowned speakers include Kevin Harrington, one of the original Shark Tank sharks, Mike Michalowicz, author of Profit First, Clockwork, Fix This Next, and more, and David Neagle, founder of the multi-million-dollar global coaching company Life Is Now. You are also in for a treat with speakers like Allison Williams, the law firm mentor, Bill Hauser, founder of SMB Team, Neil Tyra, host of the Law Entrepreneur podcast, and Andy Stickle, whose Facebook ads you've surely seen, along with 30 more. Do you know why Blockbuster went out of business? They saw Netflix coming, but decided they couldn't lose 13% of revenue in late fees. Their lack of ability to see the future and embrace change was the demise of an iconic American company. The legal industry is changing in ways you and I cannot imagine on our own. The question is, will you come to the Law Firm Growth Summit to learn how to adapt and embrace change and become the next Netflix of law and avoid being the next Blockbuster of law? I can't wait to personally greet you on February 9th at the 2021 Law Firm Growth Summit. Head over to lawfirmgrowthsummit.com to book your tickets now. And I have a special treat for you. And the reason why I say that a lot, the reason why I think this is a special treat is because my reason for starting my business, for launching the Profit with Law brand, is motivated beyond just helping businesses be successful. And it goes back to the mission statement that I have, which is to empower all people with wealth creation so that this and future generations can lead a better life. And that story stems, and I share this story a lot, but on the podcast here, I've only shared it a few times. That stems from my own personal experience with my grandfather. So my grandfather came to the US from Nazi Germany via Israel. But he was 11 years old when he left Germany, and he left with his father. His mother and twin siblings got stuck because one of them was sick with pneumonia, and his boat ended up being the last boat out, and they ended up dying in the Holocaust. So he came with his father, and his father was a businessman, started a business here, obviously came with nothing, started a business here, and started to create some excess cash, extra money that he could put to work. And together with some cousins, they purchased a apartment building in the west side of Manhattan. Now, for those of you who are not familiar with New York City and with Manhattan, the west side of Manhattan is probably one of the more upscale areas in Manhattan. And that apartment building, needless to say, over time grew and grew in what its value was. And at some point, they started to convert it into co-ops. So they started to sell off the individual units. And through the cash of those sales, it started to create some significant extra cash that my grandfather had. And what he decided to do with that cash, or with some of it, was to give each of his 36 grandchildren the money for the down payment on their first home. And he also, I grew up Jewish Orthodox, and we all went to a religious school. So we all went to private school, and he helped not just his grandchildren, but each of us, as we started having kids and sending them to school, helped his great grandchildren with helping pay their private school tuition. And being on the recipient end of that kind of kindness and that kind of generosity really impacted and changed the trajectory of my life. And I started to think, like, what can happen if I can help tons of people do the same thing? If I can help other people create that kind of wealth that it can have a generational impact, what kind of change can I have on the world? And that's really what is motivating us to do what we do here at Profit with Law. And getting law firm owners to be profitable and to throw off extra cash is just the beginning of the wealth journey. And that's why I'm excited about the episode we have today and the guest that we have here today. So our guest today is Lane Kawaoka, and Lane owns 4,200 or over 4,200 rental units He's the leader of the Hawaii Deal Pipeline Club, which has acquired over $350 million of real estate by syndicating over $40 million of private equity since 2016. Lane uses his engineering degree to reverse engineer the wealth building strategies that the rich use in the top 50 investing podcast, Simple Passive Cash Flow. So I'm really excited to have Lane here because this is going to be a conversation around what's next. You are achieving success in your law firm. What is next for you? What are your motivations? And how do we grow your overall net worth outside of the law firm? And that's why I'm so excited about this discussion. Lane, welcome to the show.
Yeah, thanks for having me. Appreciate it. Great story.
Awesome. So Lane, I want to start off, I always start off easy. I want my guests to know who you are. The bio doesn't do you justice. Give me the backstory. How did you get into real estate and how did you become this successful real estate professional where you're now teaching others how to do it or helping others invest themselves?
Yeah, so I think your audience will resonate a lot with my background. I mean, I grew up not with too much money. We were kind of middle class, but with this mindset of study hard, go to school. I just happened to be good at math and science when I was 8 and 9. So I guess they told me to become an engineer, and that's what I did. So I went to college, got an engineering degree, started working, and then I keep following this linear path, right? I think a lot of us are on this linear path of a high-paying job. I saved my money. I was pretty frugal right out of college to buy a house to live in. Because again, that's what they tell you to do, right? That's all the financial dogma is saying to do, which I don't necessarily agree with. But because I was never home, because as a new guy at work, as a young engineer, you're always out traveling. And I just thought it was silly that I was only got to enjoy this nice house on Saturday. So I started to rent it out. The monthly rents that got brought in were $2,200, and the mortgage was $1,600. I knew nothing about the 50% rule or rent to value ratios. All I knew, I was making a few $100s of cash flow, and that was where I got the bug, and that was where things all started. And 10, 11 years later, kind of got myself out of the rat race, quit my engineering job, and trying to teach people how to do the same thing.
Now, when you left your engineering job 10, 11 years later, what did your real estate portfolio look like? How did you know, like, okay, I've now adequately replaced my income and I can survive on my own without needing to, to work another day in my life?
Yeah, I mean, I had gone through several reboots prior to that. Going back to that first rental, I mean, I do more passive buy and hold investing. All this house flipping stuff and HGTV, I don't do any of that stuff, right? Like my highest and best use is at my day job or for folks listening at your law practice. That's really where you should be putting your time instead of screwing around with these rental properties. But that's what I did. I just bought and hold passively as I worked my day job, and bought a duplex a couple years later. But it's like it takes such a long period to save up the money and buy the next one. But as you buy more and more and more, you acquire more cash flow to acquire the next property quicker. Got up to 11 rentals in 2015. And then I reset to, I started to get around other higher level investors, other doctors, lawyers, engineers that were 10, 20 years older than myself. And they were all investing in syndications and private placements. And, a few years doing that, got the hang of that. And I realized, yeah, I'm good. Do the math. Passive income exceeds daily expenses. I'm done. I leave this silly engineering job behind.
So, you mentioned two things: buy and hold rental property real estate, and then syndication investing. And you also say, hey, don't waste your time with flipping properties. And I'm not even going to get into the tax discussion, but as an accountant, I know that flipping properties, you pay a lot more in taxes than when you're buying and holding and renting it out. You lose out on the depreciation aspect of it, and you also have to pay self-employment tax on the money that you make when you're flipping properties. So for those in the U.S., if you're thinking about flipping properties, it's you got to look at the tax implications as well, because you're going to end up with a lot less money than you thought at the end of the day. And buy and hold real estate is a great tax shelter
for your money moving forward, because you can do a 1031 exchange. You can roll the value of that property into the next one and never pay capital gains on it. It's kind of like the avoid tax till you die plan, if you go down that road. What I want to understand from you, Lane, is how does somebody navigate which of those two is the right fit for them, right? I mean, it sounds like you started with, hey, I'm going to acquire some properties. I got to 10 or 11, and then I went into syndicated, real estate. Sounds like you think syndicated is a better option, but maybe people are not ready to start there, or like, so how does somebody navigate between those two? And why do you think syndicated real estate is better if somebody can do it?
Yeah, so I think the two biggest factors are, number one, what is your net worth? And number two, how much money are you able to make at your day job? And being the engineer I am, I have a little chart of this with how much what your net worth is and what your how much money you make on a graph. And I'm like, well, at this point, you go to syndications. At this point, you stick with single family homes or you do it yourself. That's on my website there. But essentially, look, if you're under $250,000, $500,000 net worth, you don't belong in syndications or private placement. That's for more higher net worth, especially accredited investor, guys who make over 250,000 a year or net worth $1 million or more. And that's where I was. I mean, my net worth was under 500 grand from probably when I started in 2007 to 2014 or so, I guess. Hard to tell, but I mean, and that's what I did. I just bought single family homes. It was like, it wasn't a get rich quick thing. It was a get rich surely thing, where just kind of the equity kind of grew. And then exactly to your point, I mean, I love house flippers because they'll pay all my taxes for me. And then when you're buying single family homes, you can deduct 1/27th of the value of the home every year as depreciation. So it sort of negates the returns, but it really gets cooking. And when you go into the bigger syndications that do cost segregations, we can kind of get into what that is, but essentially you're able to draw almost a third of the property value in the first year. So, I mean, this is how you extract all these passive losses. You play the real estate professional game, and folks like myself and my clients, we don't pay any taxes. I mean, I buried my AGI down 25 grand this past year. It's zero. Paid much less than Trump.
Right. And that's why, Trump and his election campaign in 2016 stood on stage with Hillary Clinton. When she asked him about taxes, he said, I don't pay taxes because I'm smart. Right.
Yeah.
That was his comment. Right.
Yeah, and I was kind of like, you dummy, you should probably not say it like that. Then everyone will start to look at it. But yeah.
I agree. I agree with you. And I think that I think that he's got away with words, and we've had 4 years of experience of that. But that being said, there is something to be said about the fact that real estate is it really helps. And you know what? A lot of our listeners probably never invested in real estate, and they're not familiar with tax code. So I want to just lay it out for them really quick. So let's just use an example, and I'm going to let you drive. I'm going to let you share the example, but just choose an example of a single family rental, what they pay for it, what their costs are, what their monthly rent that it brings in is, and how they're producing positive cash flow and paying down the loan on it if they took a loan on it, and at the same time the tax bill is zero or even lowering their overall tax bill. So just paint those broad strokes for people who just don't understand how that works.
Yeah. So I mean, this might come as a culture shock to a lot of people, but the properties that we're buying are not in primary markets like San Francisco, Los Angeles, Seattle, New York, Hawaii. We don't invest in those places. That's where unsophisticated investors gamble for appreciation. We are more cash flow investors. So we're investing in more secondary and tertiary markets like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock. So a lot of the properties that we'll buy are in the $100,000 range. It was a big culture shock to me. I was like, you can buy a house less than $300,000 to $400,000 being out in Seattle and Hawaii, but we'll use that $100,000 purchase price, right? So the way it kind of works is we're looking for properties that are 1% or higher in terms of rent to value ratio. So you figure out the rent to value ratio by taking the monthly rent divided by that purchase price. So we're not buying anything in this scenario where it's $100,000 house that rents for less than $1,000. So
I'm gonna interrupt you for 1 second because I've had this question and I never really got the good answer for it. Especially since in my market it's a significant issue. When you're calculating rent to value, or what are you doing with real estate taxes, and like insurance costs, things like that? Are you deducting that before you're looking at your calculation? And I'm gonna add to it, like in my market, when we're looking at a single family home here in Rockland County, New York, outside of New York City, the house is the taxes on the house are going to be $15,000 to $18,000 a year. So you're talking about, okay, we collect $3,500 in rent, but 1,500 of it is taxes, or 17 or 1,800 of it is taxes. So are we deducting that out before we do this ratio?
yeah, so the rent to value ratio is like the super quick and dirty way, preliminary analysis, right? It's something that anybody can do. I mean, what you're trying to, all the taxes, insurance, you're assuming that it's sort of the same, right? Obviously, when you start to go in, dig into it on a specific property, like Florida, for example, is going to have high insurance costs because of the hurricanes. Chicago is going to have huge taxes, just similar to like what you're kind of talking about. So when you get to that level on a specific market or whatnot, now you're getting into the analyzer. People can go to my website, download my free analyzer, and then on the insurance line or the taxes line, that's where you have to bump up that line item specifically. But just, keeping it simple here, because I think the rent to value ratio, a lot of people just lose sight of that, right? That's the first stop. That's for those people online dating, that's like just the swiping right, swiping left. We don't know if they went to college. We don't know what their hobbies and interests are. This is just the quick and dirty way of first figuring out, should we go take this on another date or put it into the analyzer? So the rent to value just simply takes the monthly gross rents divided by the purchase price.
Now, if you don't know what the rents would be because it's not currently rented, you're looking at a vacant home and you're going to buy it and put renters in it. How do you determine what that rent should be?
Yeah, so I mean, great resources like Zillow. Zillow has some rent estimates. You can go
Is
on
that
Facebook
reliable?
Marketplace. No, but it's good enough, right? I mean, at least you're shooting the right side of the cow and you're getting close. You're gonna get it plus or minus 10, 20%.
Mm-hmm.
And that's where you go into like Facebook Marketplace. You look for rental comps, something same bedrooms, baths, square footage. You're gonna get it pretty dang close. I mean, you could probably, for a novice, you could probably get it within 10%. Thinking, within
Okay.
$100 and $1,000 rents.
Okay, so you figure out what the monthly rent is, you divide that by the purchase price, and if it's 1% or more, then it's worth looking at.
Yeah, worth looking at. And automatically that takes out a lot of places in the United States, right? Like in California, you'd be lucky to buy a $400,000 house that rents for $2,000. 2,000 divided with 400 grand
That's a
equals no
half
bueno.
percent.
Yeah, ain't gonna work, buddy. Right? Like 1%
Right.
or higher, because there's a rule that we follow, which is the 50% rule, where half of the rents that you come in just magically will just disappear, like to repairs, expenses. We pay a property manager 10% of the rents because we don't. I mean, how else do you scale, right? Like we're not landlords here. We're investors. We have property managers who professionally take care of the tenants, and then just putting money away for the capex. Big. The roof is going to go out at some point. You need to put money in reserves for that type of stuff. So to be really conservative, the quick and dirty rule is 50%. So that's why you need the rents to be high per your purchase price, and that's why you need to be over 1%.
Mm-hmm. Okay, so I just want to take a step back because you basically, you've got this tool that helps people figure out whether they're an accredited investor, whether they're better off doing syndications or they're better off doing buy and hold individual rental properties, right? Now, somebody who meets the criteria. Now, you said that criteria was based on their net worth and also their job. Why is their job relevant there? Is it because of how much or how little they make is going to indicate whether they're better off being busy with real estate versus working their day job? What's the relevance there in that calculation?
Yeah, so like like syndications are completely passive. You don't do anything. You invest your money and you sit down, you go to sleep. Single family home rentals, even if you buy what's called a turnkey rental where a rehabber will go and fix it up for you, fix up all the major components, and someone will even put a tenant in place for you. A little bit of work. I had 11 of them and I was starting to go crazy. You definitely, it's becoming a full-time day job just to manage the property manager if you had more than 20 or 30 of these things. So I got up to a point of 11 rentals, then I made the switch, right? Taking the jump to the NBA if you're a sports fan. So I feel like, this is all my opinion. I mean, this is very gray area, right? You have to build up your network of other passive investors, talk to other of them. But if I was just to kind of blurt out just general rules, if your net worth was higher, you're not going to screw around with these small single family homes at 100 grand, right? It's just not worth your time. I also have some investors that are young dentists that their net worth is not $250,000, but they make over a few $100,000 and potential to make more. Their time is better spent at their practice, just like a lawyer would be, for example.
Right.
So depends what I always urge my investors, my clients, like, what is your highest and best use? For a lot of my guys, it's at their 6-figure plus day job than to screw around with a house flip or a single family home passive rental. It's to go into these syndicated deals. But everybody's on different spectrums. Everybody's got different time commitments. Some people have kids, some people don't. Some people have a lot of competence. A lot of my investors are engineers, so they're very competent working with contractors and with the numbers. But a lot of people aren't. So that's where they become a passive investor in a syndication and as a passive partner.
Right. And I want to dive into the math on each one of them to really understand it. So we started talking about, single property rentals. Now, are we talking about a single family property? Are we talking about multifamily? Are we, I know that there's a big difference between 1 to 4 units and beyond that. Where when somebody's first getting started, where should they be looking as their first, dip my toe in the water? I want to get my first property as far as the type of property.
Yeah. So when you're buying a single family home, just kind of dipping your toe in, you're looking for more of a class B to C property. So not on the high end, not the luxury stuff, because your rent to value ratios aren't going to work there. And you're not going to you don't want to deal with the low end stuff, the class D or war zone properties. There's a sweet spot in the middle. And in the sweet spot is where the majority of America, right? If you were to draw a bell curve on where the most population is, it's in the middle. It's people paying about $700 to $1,100 a month for rent. I mean, most of us are probably listening to a podcast. We're probably a little more affluent. We're paying 3-4 times that for our roof over our heads. But that's the average person in America, and that's where we kind of want to stay. That's where the value is as an investor.
Interesting, because in my area, the class B and C is going to be commanding a rent of somewhere between 1,700 and 2,500 probably, or maybe even a little bit more than that.
Right. But again, we're not investing in primary markets like where you live, right? So more secondary and tertiary markets in the class B and C area there.
Well, how far away from a major city do you have to go to be considered a secondary or tertiary market? Like we're a suburb of New York City. We're not in the city. At what point, outside of the scope of New York City, for example, do I go before I say, okay, these are not people who have anything to do with the city that are living.
Yeah. So what you're kind of getting to is kind of getting in a little bit into the nuances. Yeah. Technically, if you went by population, your town is not the big city, but it's so close to the vicinity. And here's like another way of thinking about it. There's so much unsophisticated dumb money in New York, Los Angeles, San Francisco, or Seattle that those people are just looking for to drive over to the next town and buy rental properties that don't know what they're doing, and they're going to bid up the price. There's just so much demand for housing from unsophisticated money. So like, for example, Tacoma is right next to Seattle, separated by an hour's drive. But because Tacoma is so much close to Seattle, I consider that a primary market itself. And it sounds like you're the same way. I don't know the East Coast too much, but Yeah, pretty much that all up and down that coastline, pretty much all of California is a primary market. Ain't gonna work. Like I think you've got to go out to like York, Pennsylvania
Hmm.
to get to some. I work with some people out there. That's the closest you're gonna get to where you're at. And this is where the quantum comes in. Most investors realize, oh, I'm not going to invest where I can drive to it. I'm like, no, man, none of us do that. We live where we want. I live here in Hawaii, but I invest where the numbers make sense, which is
Right.
typically over 1,000 miles away.
Right. Very good. Understood. Yeah, I mean, there's obviously everybody has their own unique situation. I'm investing with my father-in-law and my brother-in-law. So his reason for wanting to be investing is to have something that we're doing together. So he wants to like be actively involved and drive around to the properties and stuff like that. So there's other motivations that are going to stick us in this market. But for the rest of our listeners who are actually interested in doing exactly what you're saying, they got to find that other market. Now, is there when you're looking at trying to decide what market you want to go after, is there something specific that you're looking for, like the establishment of some large employer or something like that you can hang your hat on and say, okay, this property is going to stay rented. It's going to have tenants because I know that people are not going to disappear from this area.
Yeah, I mean, I could probably draw up like a fishbone diagram of all these factors that contribute to it, but for the most part, it's an increasing population due to some kind of economic driver. It's basically what it comes down to. So yeah, you just want to kind of go on Google and see how the population is trending, right? I mean, that's probably the best thing you can go off of. It's an indicator of all these other factors, that schools, this type of stuff. But just remember, I think one thing that a lot of new investors get hung up on, they're trying to find the best school districts and safest areas. Like, you're buying a Class B or C property, it's not going to be the best school district. It's not going to be the safest area. There's going to be crime. Yeah, you don't want homicide there, but yeah, there's going to be drug use and theft and that type of stuff, right? And that's where we kind of get into this point of, hey man, maybe this isn't for you, right? You're going to have
You're
to
not
go in
looking for a
there.
house to live in. You're looking for a house to rent.
Right. And you may not necessarily actually ever visit this house because you're going to rely on your property inspectors, your brokers, your property managers to do this for you when you're going to play the hat of investors. But this isn't for everybody. And this is a mistake that I came, through my coaching program. I thought everybody could do this, right? Like, it's called a turnkey rental for a reason. It's simple. It's a turnkey. But I realized a lot of people just cannot do this because it requires you to build relationships with and create a team of property managers, brokers, and more importantly, talk to other pure passive investors, other high net worth accredited investors like yourself, to get referrals. Who do you work with, right? Because that's the other question. Well, who the heck do I work with? Well, you need to build organic relationship with other investors to figure out who's actually proven people. Because there's a whole bunch of people out there. Not all of them are good.
Let me share an exciting tool that I recently came across that is a game changer for law firms that bill hourly or by the project, otherwise known as flat fee billing. The 2020 Legal Trends Report published by Clio rates how important various items are in a client choosing your firm. You may be surprised to know that the third most important decision factor for someone choosing a lawyer is the ability to pay with a payment plan. The challenge that law firm owners face is the risk of a client not making good on that payment plan. Most attorneys don't offer payment plans because of that. The problem is now solved with LawFunder. LawFunder allows you to easily add a payment option to all your client invoices and retainer replenishment requests that does not require credit checks, applications, or any other complex process. The client's able to use their existing credit cards, allowing them to earn points and miles, access credit card specials on interest rates, and any other tools they use to manage their cash. When I saw this tool, I was blown away. Most importantly, it removes all the risk from the law firm and makes an easy and painless process to the payment process. So if you want to check off the box on one of the top factors in new client decisions, if you want to decrease your accounts receivable and get paid immediately, LawFunder is the solution. Go to lawfunder.com. That's lawfunder.com. fundar.com/profit-with-law to learn more.
And we're gonna spend a little bit of time on syndication for sure. I want to touch on that because there's definitely some people who are listening to this that's for them. And and something that I've been approached by a number of people. And the reason that I haven't invested yet in syndicated real estate, I understand the concept, but I don't know how to vet the individual opportunity. Like I don't know what are the right numbers to look at to know if that's the right thing. So I want to get to that. But when we're looking at buying a property, we found a market that we're happy with. We found a property we're happy with as far as the 1% rule, the rent to value ratio. What are the next steps in determining whether or not this is the right property, and how do you estimate the various expenses, the property manager fee, the capex, the money you need to save for those capital expenditures? What's the process of mapping this out so that you can really make sure that this is going to be a good investment? And are we looking? I'm throwing a lot of questions at you at once because I'm sure that it's going to be one succinct answer for all of it. Are we looking for cash flow positive, or is because if you're taking a loan out, then you've got some of the principals getting paid as well at the same time. So the fact that you're not getting cash flow out of the property doesn't necessarily mean you're not building that equity in it. So how do you approach that whole calculation and determine, okay, I did the swipe right, and I don't know, I don't use dating apps, so I don't know which one's the yes, but let's just assume that swipe
I don't know
right
either.
yes, right? I did the swipe right on this property, and now I'm looking at it. What are the next steps?
Yeah, I mean, I have my analyzer, which I can display on my screen if you'd like, but basically you run the property through the analyzer.
I'm gonna allow, so for those of you okay, this is an audio show, but we're also recording video. So I am gonna allow you to share your screen. I just gotta turn on the security setting for that. You could share it, but let's make sure that we're verbalizing everything that you're showing me for our audience. And that's turned on. You can do that now. And if somebody wants to access this analyzer, is that something that you have available for download?
Yeah, it's free. I think it's at simplepassivecashflow.com/analyzer.
Okay. Well, and folks, we'll link that up in the show notes. So my team will make sure that link is correct. And if it's wrong, we'll get it corrected. We'll put the correct link for you in the show notes of the episode. All right. So go ahead.
Yeah, so you just put in, the big ones are like, what's the purchase price and what's the rent? This is what kind of primes the pump here. And then there's a lot of assumptions here that, 20% down payment at 5% interest rate. This is probably too high at 5%, but you just kind of want to be conservative, right? And then what you're asking on, like, all right, all these expenses, so they're all listed here. So taxes, insurance, property management percentages, listing fee, vacancy, maintenance, CapEx. I even have a little CapEx calculator down here if you want to geek out and figure out what the actual cost per month to add into the analyzer. But it has presets, right? Conservative presets in there for each of these line items. And after that, you want to see what's at the bottom of the page and are you cash flowing? So to answer your question, yes, you want to be able to cash flow. And for $1,000 rental property, I probably want to cash flow at least $100, assuming that this analyzer is super conservative, right? Like I want to be presently surprised when I cash flow $200, $300 at the end of the month.
Let me interrupt you for 1 second. Should the cash flow expectation be a percentage rather than a dollar amount? I mean, you were talking about properties that are 100,000. What if I'm actually buying a $400,000 property? Should I expect to cash flow $300 or $400 rather than the $100? Is it like a 1% of the month of the rent, or 10% of the rent? What's the
usually like 5-10% is a pretty acceptable range. But
okay.
Rental properties, things go up and down, right? You have good months, you have bad months, and this is where it's not for everybody, right? There's somewhat of a risk involved with it. So like that's a very common question. My investors ask all the time, like, is 8.7 the right cash flow number? Is it 9.2? I'm like, dude, 5 to 10. You get in there, it's good enough, right? Because this thing, it's like It's like working with a new golfer, right? Like just get it down the fairway, bro, and you'll be fine. We'll be happy with that.
And
Because
that cash flow you're talking about after taking off your capex, after taking off your property management expense, like after taking off even the expenses that are not real but are projected, that's where you're calculating, correct?
right, right. A lot of new investors drives me crazy. They're like, oh, my mortgage is $500 and my rents are $1,000. I'm cash flowing 500. No, that's not how you do it. You got to take out all your taxes, insurance, property management, vacancy, repairs, capex, and anything else you're paying for. And then there's some, I have some like footnotes here if people want to kind of sharpshoot it, like, and then this is where you kind of get into the weeds, right? Like in New York, I don't know why we'd be buying in New York, by the way, but like you got to bump up your taxes, right? Or Chicago, right? Chicago's
Right.
sinking like a quick ship. But going back to your original thing about the $300,000 house, it ain't gonna work. Once you go over about $150,000, your rent to value valuations are gonna suck. It ain't gonna work. But hey, you guys got to come to these conclusions on your own, right?
Right.
Don't listen to me. I'm just a person. People lie. Numbers
Right.
tell you the truth. It ain't gonna
Right.
hit the 1% rent to value ratio if you go that high.
Right. And I guess it also has to do with like if you're buying a multi-unit, like I'm looking at a multi-unit it's 400 and change, but then it's 2 units. So each unit is 200 and change. So now we're not at a $300,000 property, we're at a $200,000 property. It just happens to have two of them. Right.
But is the monthly rents on those $200,000 units $2,000?
Yeah. Yeah, they are. They're 2,200 each. Yeah.
Well, yeah, then proceed forward and then, like you said, put it into the analyzer. But here's the biggest thing that I have all my students do is like, well, build this data point collector because I don't know how it is in your particular market.
Right.
But you have to figure out where the market is, right? I don't know if
Mhm.
that duplex is what you're saying is good, or if it's a horrible deal, or if it's a really
Right.
good deal, right? So you got to go out on some dates, right? Like
Yeah.
see how the market is, and then you just got to pick the rest. And then I would say like once you get about 20 or 30 data points, you kind of have an idea of what's a good deal, what's average, what's a sucker deal, and buy the best that you can get.
Right.
Is the answer.
So patience is really important in this game.
Yeah, you got to kind of know what your buy box is, and you have to know going in that you're going to cash flow safely.
Mm-hmm.
And that's why I think, like, in a way, people are always asking me like, "Oh, why are you buying all the time?" Right? Through the pandemic, and because we picked up 5 apartment buildings this past year. Why are you always buying? Shouldn't you stop? You know, we should wait till the election. Like, man, I don't care, right? Because like people always are paying rent. Like we had 97% collections through the pandemic of all things. We don't buy in blue states where people complain that they don't have any money. We buy in red states where the laws are on our side. So I don't feel any of this like CDC rules and all that type of stuff for, memorandum of evictions.
Is that a factor? Is determining the political affiliation of the state a true factor in whether or not you should buy a rental property there?
Yeah, but it's pretty much like the primary markets, a lot of the blue states anyway. So we don't go there anyway. Like
Mm-hmm.
again, New York. Hate to pick
Right.
on you, but
And
like
what's driving that? Is it because of the eviction laws and stuff like that?
um it's it's eviction laws and then the landlord laws, right? Like in places like Georgia, right? Like if you can't pay, you can't stay, and the sheriff comes up with a gun 30 days later and you're out on the streets if you don't pay. Or in California, I don't even know, it's like 6 months to a year,
Yeah, New York
right?
also. It's quite the
Yeah.
process to get somebody out.
I mean, the numbers don't even work in the first place there, and you have the courts not on your side. It makes no sense to me.
Right.
Um,
Very interesting and very
so,
insightful.
so all the news you read is all fake news. It's all like predicated on more of the tech markets, the blue states. But that's not what I'm seeing in my portfolio of 4,200.
Right. Okay. I think I'm beginning to understand. We use this calculator. We make sure that we're cash flow positive. After we did our initial check and decided to swipe right, then we went and did a bit of a bigger deep dive into, how the property is going to fare. And then we go ahead and we make the purchase, and we hire a management company, and we start collecting rent. What about structuring the legal entity and tax advice? You just say, hey, check with your local accountant, or are you aligned with somebody who specializes in this, and help provide with the right advice?
Yeah, I mean, you want to work with guys who own rental properties and understand this. And what I'm about to say is not construed as legal or tax advice, but I'm gonna go out on a limb and say most tax guys and most lawyers don't have a clue what they're doing in terms of this real estate stuff, which is why they still have a day job and why I left mine a few years ago. Um, if they are, I mean, I was an employee once. I did things the easiest way and the most conservative way, where I keep my job and my license, right?
Yeah.
I tell my investors in my mastermind group that you guys need to empower yourselves to know the tax code. It's your job to understand that as an investor. I mean, your number one expense is taxes. Your CPA, their job is just to do the forms. To ask them what do I do tax wise is not fair, because they don't know what kind of deals you're going into. They don't know what kind of risk reward profile is. They don't know how much passive losses you're going to get from that deal. They don't know what you're going to sell 3-5 years from now. It's unfair. It's kind of like telling your contractor, hey, make me a nice bathroom, right? But you don't do that. But that's what people do with their tax person. And this is where you have to build a network around you of other passive investors, affluent investors doing the same thing and seeing what are the best practices.
Yeah, absolutely. And the interesting thing is that, something so basic like, hey, I got to put the property into an LLC, and I heard that, you need to separate your properties into separate LLCs because of protection, but then you don't realize that the 1031 exchange has to happen to a property that's in the same name. So if you suddenly want to do a 1031 exchange with multiple businesses that have different names, all of a sudden you got a problem. So you really have to think in advance of what your overall plan is and understand the nuances of the law of what you're going to come across later to position yourself properly from the get-go. So you don't want to take any of this for granted. You want to make sure that you're doing it right.
And just to kind of throw a wrench into the gears, like every situation is different, right? Like two counterpoints to that. It's like in my circles, we don't do 1031 exchanges. I don't know why anybody does them. We have passive losses from the bonus depreciation and syndications that wipe out our capital gains all the time. I did a 1031 back in 2014. It's one of the most ridiculous things, because you have like 45 days to identify your next property. So you're always going to be going into the next deal, and everybody knows you're a sucker buyer. You always pay a premium. When I sell the properties and I get a 1031 buyer, I'm like, all right, I know I have a sucker on the line. Any chance I get, I'm going to bump that price up, because that guy's a captive audience. So that's why we don't do 1031s, right? But it's in a certain situation, right? Depends what you're going down. And another thing, like, again, this is not legal advice, but like, look, if your net worth is under $200,000, it may not be worth it putting in an LLC, right? Some of the best asset protection is being broke.
Right.
So this is why like, there's just so much like random advice out there. You have to either find a mentor or find a peer group that kind of helps you in your particular situation.
Right. Very good. Well, well said. All right. Awesome. So are we done with that calculator? I'd like to move on to the syndication conversation. Yeah, absolutely. So, all right. What is a syndicated deal? How do you make money with it? Why is it such a beautiful thing for investors?
Yeah, so syndication is a term for pulling your money together with other investors and then typically going after a larger project. We specialize in apartment buildings, and we try and stick between the $5 to $20 million range. So that's usually 100 to 300 unit apartment. For a couple of reasons, like we stay above unsophisticated money, right? Your mom and pop investors buying your duplex, fourplex, eightplex, 32plex. They're always unsophisticated and always overpaying. So we want to get above that level. But we want to stay below the institutional players that are just investing people's retirement monies and hoping to get 5%. So there's a nice little sweet spot in the middle. Economies of scale, when you go after a larger building, you can put a property manager in the property at all times when you get above 50, 60 units. But in my experience, you really want to get that property manager plus the guy running around in the golf cart, knocking out a work order that would be a $600 third-party property management or plumber fee, right? That guy just does it under his salary. So you want to get above 100 units. So how do you take down this large apartment that's potentially $5 to $15 million, but you syndicate it with other investors? And the analogy I like to use is like an airplane. So in an airplane, you have the cockpit where you have the general partners, the GPs. These are the managing members that put together the deal. They find the deal. It's like a 1 out of 1,000 deals. They're using their connections. They're putting the loan in their name. So the passive investors don't need to put their loans in any debt in their name. They're operating the deal. They're sending out distributions. They're doing everything. And then in an airplane, you have the coach, right? So all the passive investors, the LPs come on board. Normally the minimums in private equity world is like $50,000, $100,000 minimums, which is like another reason why, if your net worth is lower, you just shouldn't get on board, right? It's the large sum of your net worth. My general rule is not to put any more than 5% of your net worth to any one opportunity, right? Just in case the plane goes down. And that's where this analogy kind of comes full circle, where the general partners and the passive investors are aligned, right? The passive investors can go to sleep, cash their checks, knowing that if the plane goes down, the general partners are going down with them too. And so everybody's aligned. And this is usually structured with a regulation 506D or B or C, where this is all kind of intertwined with the SEC. It's kind of like a mini IPO in a way. That's really where the lawyers get involved. But you need to be a big enough deal for it to make sense to pay the $10,000, $20,000 of legal fees to put this all together. Because this isn't no dinky little JV agreement. This is some serious stuff.
Right.
It gets registered at SEC, but that's how essentially a syndication is structured. And you can invest in the syndication can invest in whatever, right?
Yeah, so I've heard a number of different things when it comes to syndications, and I want to preempt this with the overarching question, which is, hey, if I put my money in the stock market, I buy some shares, I could sell it tomorrow, take my money out, right? The liquidity is there, the ability to access the capital is there. When I go into a syndication, I'm putting my money in. What is the exit strategy? When, how do I access my investment? How do I get it out of there? And how are my returns paid out to me? So is it like, hey, I'm investing in a buy and hold real estate. Now I'm getting a little bit of extra cash flow every month. And then at some point I can sell it and also make a little bit on the selling price. And now I've gotten my return, and whatever that return is, hopefully it's hopefully it's big enough that it was worth getting involved in that in the first place. And I've heard some syndications pitch to me that, hey, this is going in with, a plan to rehab these units, raise the rent roll a certain amount. Now the value is higher. We're going to turn around and refinance, and then you get your capital back, and then you're still involved 100% in the deal as far as your percentage, but you're not tying up your capital anymore. So what is the overarching play? What should somebody expect as far as, how they see their returns and what the timeline looks like?
Yeah, I mean, every deal is different, right? Everyone has their different business plan, but typically you have some kind of value add project where, I like to go into deals that are stabilized, so 90% occupied or more, so I can get that Fannie Mae, Freddie Mac non-recourse debt, which is super important. And that typically means the property is cash flowing day one, so paying out distributions, but really we're rehabbing the units, right? And we like to specialize in like light value adds, so new flooring, new appliances, but we don't really get into the big stuff. We're only doing maybe like $3,000 to $6,000 of rehab per unit, so we can bump the rents up $100. But that's enough to get an equity multiplier of 2, or doubling people's money every 5 to 6 years, should everything go right. But like in that situation, the money is sort of illiquid, right? You can't pull out. Like, and then I asked the question to the investor, like, well, why would you want your money out? Is there anything else out there that is a better return on your money or better tax plan?
Mhm.
No. Why would you want out? Well, if it's like, well, if something comes up or an emergency, then I turn it back at them. It's like, well, dude, then this isn't for you, man, because the other investors are here are accredited. This is only 5% of your net worth at most, right? This isn't for you, buddy.
Right. Now, passive losses can offset passive gains, right? So when you get into a syndication deal, you build up these passive losses. So what can somebody do when they're first getting started? Are they is that just building up as something that rolls over year to year, or is that something like they should first get to the point where they have passive gains from something before they start enter into one of these?
I mean, either or, but like, yeah, passive losses can offset passive gains. But you're probably gonna get a whole bunch of passive losses built up because a lot of these deals you do a cost segregation, so you could pull out a whole bunch of passive losses that first year. Right? It's part of the bonus depreciation laws put into 2018. And that doesn't phase out, I think, until 2022, 2023, or and with a step down basis on that. But yeah, like I've seen investors, they put in 100 grand and they get like 50 to $100,000 of passive losses the first year, which they just kind of put in their back pocket, right? So I mean, a lot of investors that are in a lot of deals, they're walking around with a few $100,000 or $500,000 of passive losses. So when they get gains, they just reach in their pocket and offset it. I guess my good example would be in 2018, I sold 7 of my rentals that year. I had a $200,000 capital gain from those rentals, but I had several $100,000 of passive losses. So I took $200,000 of the passive losses to offset the $200,000 capital gain, paid zero. And that's why I don't think 1031 exchanges are a good idea, or it's not as good as doing that.
Right. Now, so among other things, and I haven't shared this with my listeners, this is going to be the first time they're hearing this, but among other things, I also am a stock investor. I'm also an options trader. Not active, not like I'm sitting there watching the computer every day. I'm not day trading, but these are different areas where I am playing around with my expertise and getting really good at something so that I have these other ways of making money. Options trading produces, if I do it right, so I'm profitable, produces a lot of short-term capital gains. Is this a good strategy to look at syndication to offset those capital gains that I'm throwing off from my options that are, to offset the losses from my, my real estate to offset the gains that I'm getting there?
Yeah, so I'm not a stock guy. I kind of focus in my lane, but my interpretation is like that is more active income. Because right, the way I understand things is like you have active and ordinary income or money from your day job or your business, and then you have passive income and passive losses. So within this category, you can offset it. But what you're talking about is not in this category. It is an active income category, the ordinary income category. So you cannot. There's a barrier, right? You cannot use the passive losses to offset that unless you are a real estate professional. I think. I know I have a lot of doctors that make a whole bunch, like $500,000 plus salary, and they employ a real estate professional status strategy with their spouse, do 750 hours active participation, some other rentals, and they're able to use the passive losses to lower their income. That's what I personally do.
Right.
That's why I bury my AGI down to nothing. But as far as like the stocks, I'm not quite sure. But what I do know is opportunity zone deals is kind of like that golden dollar that you can use to offset whatever you want. So that
Right.
would be an option.
And I have no idea about opportunity zone, and I don't think we're going to have time to talk about it. But I do want to talk about real estate professional status. There's all kinds of rules around it, but basically the broad strokes is not only you have to have more than 750 hours, but you also need to have more hours spent on real estate than in your any other endeavor that you do. So the spouse is a great thing if your spouse is not working. because then it's easy. 750 hours is more than zero, and you're set. But if your spouse has a job or you have a job, you have to overcome, and it becomes very difficult to get that real estate professional status because you have to prove that I'm working more hours on real estate than I am on anything else combined. So you got to be really careful about that. But my question is when somebody is using syndication deals, right? What are they busy with? Where's the 750 hours coming from unless they also have active rental properties that they're managing? Like how does somebody like that navigate that real estate professional status?
You're right. You're right. So when you're in syndication deals, you're a passive investor in LP, which is also nice for liability, pretty low liability too. But you're not a managing member. So you're right. The trick is you've got to group this with other properties that you own directly. Or big trick that a lot of my guys are doing is they're just getting a little short-term rental. Actively managing that. That takes up that's a cash, that's a time suck right there.
Airbnb. You get yourself an Airbnb, you manage it, you got to put new people in there every week or every couple of weeks. So that's a very highly actively managed thing. And then you make the election on your tax return to treat all of your real estate entities as one unit, and voila, there you go.
Yeah, and I'm not, kind of stepping outside my bounds there. Just a reminder, I'm not giving tax or legal advice. This is where you have to understand how this works, what we're talking about here, and you not quite put a gun to your CPA's head, but like say, hey man, how are we gonna make this work, right? Like,
right,
is this cool? Are you gonna check the box for me? People need referrals. I'm welcome to give referrals that people are willing to kind of work with you on this stuff, but this is kind of where, example, you have to educate yourself, right? How am I gonna get those 750 hours? Let me create this story, this synopsis. Does my CPA buy it? Will he stand behind me?
right.
Sign my return.
Yeah, and I want to even point out and this is a perfect point to what you said earlier, that not every lawyer and not every CPA is going to be familiar with real estate, right? I'm an accountant. I serve law firm owners. I don't do real estate in my accounting practice, and therefore I'm approaching this conversation from I have a general knowledge of certain codes, but if I would be doing an injustice to take on a client right now, and as a matter of fact, I've turned them away when they're doing real estate deals because I don't know the nuances to be able to support them properly. But many tax preparers are not going to tell you that. They're just going to take the
super
forms
refreshing.
They're just going to give you the forms that you give them forms at the end of the year, and they're going to put your tax return together, not understanding your picture, not helping you strategize and figure out how to be strategic with this. And why are we focusing so much on taxes? Because that is one of the compelling reasons to get involved in real estate. I mean, besides for the fact that it has a decent return, it's less volatile than things like the stock market, but you don't have an IRA for real estate, right? Real estate is the IRA. Real estate is a asset that's going to give you returns that are going to also protect you from taxes. And once you become that active real estate investor, now those losses that you have can offset your income, which is the sweet spot. So a really great conversation. And we're out of time. There's so much more that I'd love to dive into. So maybe we have you back on at some point. But I'd like to know what is two things. First of all, if there's one piece of advice that you can walk away from here, leaving with people, assume that they're not doing real estate investing right now, what would that one piece of advice be? And then number two, how does somebody find out more about you if they want to dial into your brand, they want to learn more about it? What are the next steps that they take with you?
Yeah, so I think you got to figure out what your highest and best use is. For a lot of you guys listening, I think real estate is a great end game and side gig, right? Especially from the way I do it, the passive investing kind of standpoint. For some of my guys, they're doing like a startup. And I'm like, yeah, don't invest in real estate yet, because this is more of an end game. Take your money, buy staff, pay for marketing, right? That's gonna be your highest and best use to make that starting capital. And then once you make the bunch of money, or you're good in terms of your operating budget and your business, then put it in as much as you can into real estate and grow it slowly over the years. It's the best thing. And if you want to like get a hold of me, check out my website at simplepassivecashflow.com. More specifically, if you're under that, $500,000 net worth threshold, I would recommend getting like a turnkey rental. The first dozen podcasts I did back in 2016 were more tactically like that stuff. But if you're higher net worth, maybe check out some of my later podcasts as I've kind of grown to be more of an accredited investor. And then, check out the website and connect me on there.
Awesome. Really good stuff. Thank you so much for your time and for sharing all of this knowledge with us. We really appreciate it. Folks, if you really enjoyed this show and you want to check out more of it and you're not currently subscribed, just hit the subscribe button on your podcast player. And this way you'll be notified when we drop a new episode. We do that twice a week, every Tuesday and Thursday. And we try to bring you great talent like we just shared with you now. And one last thing. And I kind of do this at the end of every episode, and it's like a broken record, but the reality is that people just don't take action. And our podcast lives on ratings and reviews. People will check us out based on the number of ratings and reviews that they see, and we need your help. We need you to just go into your podcast player, click the ratings and review button, rate the show, give us something. I don't care what it is. Give us a number of stars, give us a little description, a little shout out, and we'll be forever grateful for you. And you'll also be helping others, because every time that somebody does that, there's somebody who may decide to listen to the show because of you. So we'd greatly appreciate it if you did that. Until next time, the name of the game is having a plan. You gotta think big picture. You gotta figure out, what is it that I want out of life? Create goals that of where you want to be, and then aim for those goals. And if real estate is one of those things, then great. Then you're going to check out simplepassivecashflow.com and check out the Simple Passive Cashflow podcast and listen to it and get dialed into somebody who's got the knowledge, somebody who knows what they're talking about when it comes to this stuff, and educate yourself. But if real estate's not for you, that's okay. There's plenty of other ways to deploy your capital, plenty of other ways to make money, and we're going to help you find out and navigate what that is. But the bottom line is you got to have a plan. You got to know where you're going. So start there. And then once you've got that extra capital, you can start to put it to work. Take care.
Have you been enjoying the show? We sure hope so. To make sure you never miss an episode, be sure to hit the subscribe button in your podcast player app. Next week, we will be back with more valuable resources and ideas on how to break the mold and take your law firm to the next level.